Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Thanks for joining us today. We're going to be talking about part 12 of Nelson Nash's book. He calls it an even distribution of age classes, and if you have not read the book yet, we highly recommend that you do so. We'll make sure that we've got the link to the Amazon, a link to Amazon, so you can purchase it there and follow along with us.
Great. Now, this talks a lot about legacy.
It does.
Right? In fact, he even starts it with a quote saying, a good man leaves an inheritance for his children's children, Proverbs 13:22. And I will say, to be honest, when I first learned about infinite banking, I know one of our mentors was really big on the legacy. And to me at that time, it really wasn't important to me. Right?
Why do you say it wasn't important?
Well, because you know what? I had just come off, I was still beaten up from the last financial crash.
Okay.
Right? And then I had 2 kids. You know, I wanted this, my focus was I wanted to send them to a private school. I wanted to make sure that we were financially stable. I mean, my priority really wasn't what the kids was what we were leaving the kids, right? But looking back, though, I do think I was mistaken here. And in part, like when we mean legacy, it's not just dollars. I mean, it's also sense, meaning like common sense or knowledge. And that if you're working with us and you're practicing infinite banking, you're going to leave a fairly large financial legacy to the next generation. And if we don't teach them how to handle money now, particularly when they're young and we have their ear, right, and control. I mean, not control. Well, we do, but to
an extent,
or we think we do.
Yeah,
right. But that's the time where we can feed into them and plant the seeds of financial legacy and education.
Yeah, totally agree.
Right. So I don't know if you can relate to that, and you were. You know, you're thinking, well, man, I'm just worried about making my mortgage payment or, paying my bills. Do not disregard this piece, because I think that there are some great nuggets of information that Nelson has in this chapter. And like typical Nelson, he loves to share stories and parables. And if his history or his experience started as a forester, and he shared the story of if you're going to plant trees in this forest, you're not going to plant them all at once. You're going to spread them out evenly. And he had the example, if somebody had, I think it was 4,000 acres.
Yeah.
But in essence, he broke them up into 40 different lots, right? And then that first year, they would plant seeds, in that first lot number 1. Then in year 2, they would plant seeds in the second plot and so forth. So it's a very long process. At that beginning, there's no revenue, right? If anything, there's expenses in maintaining the land, property tax, and all of that stuff. And then it isn't, in this example, in year 25, do they do the first cut. Yeah. And then they take any of the trees that aren't that healthy, they will cut those down and sell them. So there's a little bit of revenue in year 25, right? So they're planting seeds in year 1, and they're not harvesting anything until year 25. One of Nelson's rules is think long term, and this is a prime example of thinking long term. So it's not until year 25 you see $1 revenue. And then what they do in forestry, about every 5 years after that, they will do another cut. So they're going to get out some of the old or the underperforming trees and sell that to make a little bit of revenue. But so it takes a long time, right? About 40 years. And then finally, at year 40, now you're able to one large harvest in that year. But then also, since we're doing those cuts about every 5 years, so really every year there's 4 sources of income, and you really don't see an ounce of that profit or that money till 40 years later.
Absolutely. And Nelson, at the bottom of page 71 on the left, as he's talking about the 4 sources, and then at the top of page 71 on the right, he says, once we have the whole system completely established, it's a fabulous income producer, but it's going to take 40 years to get it done. 40 years is 2 generations. It's 20 years each, right? Which is thinking long term. And when I read that, one of the first things that came to mind was, man, it doesn't have to be that long, right? I mean, if we compare kind of what Nelson was doing on the forestry side to setting up a properly structured policy and then starting a banking system, it doesn't need to take that long. So you talked about waiting potentially 25 years before we have that first dollar of income coming off to us. And we started talking about how that would relate or look like in a banking scenario. And if somebody is funding a policy, right, the policy would be the first source of potential income. Right? Or you're funding the policy, you've got cash value in there. That cash value is going to grow. And I think what Nelson's looking at here is he's specifically referring to the death benefit, and we're going to get into that later. But he's saying that, hey, there's going to be a death benefit that's established that's going to create a windfall that can go from one generation to the next. But in this instance, in our example, I'm going to talk more about the cash flows because you're creating cash flow or cash value in that policy that you can use immediately. And he talked about 4 sources of income, 3 sources of income in a banking system. Number 1 is what we had talked about is you can pretty much classify any purpose or any loan that you take against your policy under 3 categories. The first one being for debt recapture, right? So if somebody's got some debt, right, we can pay off that loan and recapture it, redirect the policies. The second one would be lifestyle. That would be vacations and those things, right? And then the third one would be all of those opportunities to create a wealth, which would be the wealth creation opportunity. And so Nelson here, he's talking about really, I think he's alluding to the fact that you've got a death benefit that's going to take a very long time to create. But man, if you look at funding a policy and then taking a loan against your cash value and working towards or using it towards those opportunities for debt, lifestyle, or wealth creation, man, you can start doing that on day 1.
You want to know what I first thought when I read this years ago?
What did you first think?
Well, I'm like, yo, Grandpa, why didn't my grandpa plant some trees or start a policy for me?
Yeah.
Right? So that was my first reaction. My second one is, I don't want my grandson to read this book and say the same thing about me. And actually, being over 40 years old is kind of like, time goes by pretty fast.
It does. Goes quick.
Yeah.
So in regards to, speaking of grandpa, right, on the second page, the second paragraph from page 71, Nelson's talking about funding a policy, and he gives us an example. And the example that he gives in the book is he says, hey, what if Grandma and Grandpa were to fund a policy on a grandchild and they were to pay $2,000 in premium for 22 years? Anthony, what are your thoughts on funding a policy at $2,000 and for that time frame?
Well, I tell you, first of all, I'm a big proponent on getting policies on children. Like we did some on our kids, and I will tell you, I'm looking forward to being blessed with a grandbaby. And when I do, I'm getting a policy 30 days later, right? But what I think Nelson is doing, what he's showing is you pay the premium for 22, or grandpa or grandma pay the premium for 22 years, and then we don't pay it anymore. To be honest, I would not recommend that.
And why not?
And in part is we have to view, here's an important thing, or important question, is your premium, is it a deposit or is it an expense? Right? And I would view an expense is when money goes away from you. But a deposit is moving money, is depositing money into account you own and control. So if you view it as an expense, you want to stop expenses as soon as you can. And I will tell you, when I've seen some other insurance agents design a policy saying, hey, well, you only need to put it in for X amount of years, or it's paid up at 65, or, they're turning off the premiums. But our view is that premiums are assets, and you shouldn't want to stop paying premiums until you want to stop paying, until you want to stop building assets. So for me, in this example, what I would do is have that 22-year-old start paying the premiums, right? They need to have some skin in the game. So I would teach them about infinite banking, have them read the book and say, hey, grandson, I've been funding this policy for you for 22 years. Now it's your turn.
Okay, so the scenario that you're describing is Grandma and Grandpa funding a policy for 22 years and then transferring ownership to the child 22, 25-ish years old, however young they are, right?
Mm-hmm.
So let's talk about that for a minute. What are some of the pros and cons that come along with that, right? Is what might be some advantages to giving a kid access to a policy at 22 and what might be some disadvantages?
Well, it depends how you define access. Like what I've done with my kids, I have a son 27 and 21. So we've gone through their education.
Mm-hmm.
And what we've done is we got a policy for them when I first heard about this concept. Before that, we were doing a 529 plan. And you may have heard me share the story where my son lost 60%. Or did he lose 50? I don't know, but one lost 50 and one lost 60 and one was lucky and only lost 50%.
Yeah.
So then it was like, you know what? And this is when my son was going to college in 2 years. So we didn't have the time, like my financial planner said, to wait it out. So we moved that money out, the 529 plan, and put it into their policy. Now, with my son, we've used policy loans to finance his education. And we're doing the same with my daughter. And now that my son is done with his education, now keep in mind, right now, my wife and I are the owner and control of this. He's the insured, so it's on his life, but we have full access to the cash value. Okay, which I think is important, because if they have like an investment account or commonly called like an UTMA account, or when they turn 18, they have full access.
Mm-hmm.
So here, my son's 27 and I have full access. But what we've been doing these last couple of years is my son's been paying the premiums.
Nice.
And I said, look, now you don't have any student loans, and wherever you're working, most of your cohorts or have student loans. Well, you don't. You have policy loans. And so if you start paying those loans, just like your co-employees are, but the big difference is, and this is huge, right? If you have a student loan payment, who gets that money? Right?
Student loan company.
Right, student loan company. But with my son, when he's repaying that loan, who has control of that money?
You do.
Yeah, I do. And now he had to prove that he could be a good steward of money, that he could pay the premiums and that he could repay the loans. And he's now proven that. So we just need to get together to sign the paperwork. But now I'm going to gift him this policy. So, we've talked a lot about, one thing we talk a lot about is what's seen in the policy, right? What's the cash value? What's the death benefit? What's the growth? But it's hard to justify the unseen. And so that unseen is now my son, not only does he have permanent death benefit, okay, and so does my daughter, which my daughter, without going into too much detail right now, is uninsurable because of some health issues. So she might not ever be able to get more life insurance. So the unseen is that I've secured her some death benefit, but also he's got a policy that's about 12 years old, man. And if you see these policies, they get more and more efficient each year. So I don't know that I should have pulled the numbers, but I think his premium on one policy is $2,400, and last year it grew by I think $5,000.
Nice.
So it's growing. He's putting in $1 and it's growing by more than $2. But I think most importantly is that as far as the legacy goes, we're teaching him knowledge.
Mm-hmm.
We're teaching him basics about money and being a good steward. Sorry, I think I got off on a little tangent there.
That's all
You're
right.
getting me fired up.
You were going, so I was just letting you go. Yeah,
Okay.
I was getting out of your way. Anthony just talked about how they're actually implementing the policy loans and using those and to create the business. But I'm a little farther behind you.
Hey, no comment. Okay.
My kids are 10, 8, and 6, and I'm more at the education phase of teaching these kids about money. And
I don't mean to interrupt you, but I am. But I'm going to kind of give you a compliment. Cameron, you are behind me as far as like in regards to the children, you know, on where they're at. They are younger, but I would say there's two things that you've done that I wish I would have incorporated when I was in that stage. Okay, one is I wish I would have taken better care of my hair. Okay, and two, you shared some stories on how you're educating your kids at such a young age, and you even shared a little video with me today. And man, I think that is so cool on what you're doing with the kids on teaching them about money and the free market.
Well, thank you. I did not see that first compliment coming.
I know.
But the second one, I kind of had an idea. But so what I was telling Anthony is that Anthony mentioned before is it's about dollars and cents. Is my kids are at the age where, right, they don't need money really for anything.
How old are they?
They're 10, 8, and 6. My son Declan, he's 10, and then I got two girls, Reese and Finley. Reese is 8, and then Finn is 6. And right, they're doing chores around the house, and we'll pay them for those things. But it's really difficult to talk to them, right? There's not a curriculum around money that's in a structured school system, and so you've got to kind of do it independently. And one of the best resources that I've come across so far is a book series. It's called The Tuttle Twins, and I will be sure to include that in the show notes. But if you guys have not heard about it, look these guys up. It's a series of 11 books written by Connor Boyack, and they are excellent. And what I've done is I bought all 11 of them, and I started reading them to my kids. And I just gave him an incentive earlier this week, and I said, okay, right, this is for Declan. He reads quite a bit, and so he started reading them on his own. And so he was excited because I think book 4 talks about the creature from Jekyll Island. And so he was telling me about how all these really wealthy guys created this bank, and it can print off as much money as they want. And so he was excited to tell me that story. But what I did is I made a deal with him. I said, hey, listen, I said, for every book that you read, if you're willing to do a report, whether you write it out or whether you do a video diary of it, I'll pay you $5. And he was ecstatic. And so just last night we did our first one. So I think we did the Tuttle Twins book is their interpretation of I Pencil by Walter Reed, yeah. And so what he did is afterwards he read the book, and I set up my camera and I interviewed him. There's 5 discussion questions at the end, and so I went through it and asked him those 5 discussion questions. And at the end of it, I said, hey, would this be a good takeaway for you? Or what's your takeaway? Would you recommend it for some other kids? And he's like, yeah. He goes, I would definitely recommend it for kids that want to learn about financials and about the free market. It's like, dang, all right. At 10, he's talking about free market. I love it. All right, so right, it's one of those things. And then Reese, she wanted to get in on it, so she wanted some money. And so what she did is she's a little more reserved, so she didn't want to do the video. But she wrote a 1.5-page report on the book. And then Finley wanted money too, so I had her read me just another random book that was age appropriate. But no, man, I was super excited. I love having those types of resources, and it's really difficult to find. So I'm a big fan of the Tuttle Twins books. For anybody that has not come across those yet.
No, I think that's great because a lot of times when the kids are that age, like maybe, we teach them about allowance and earning, but we can't teach them some of the bigger ideas. So those books are great. As your kids get older, another way to teach them financial education, I think is a great way, is to play the game cash flow.
Mm-hmm.
And we actually played it here in the office about a month ago, and we had in the office we had the number one realtor in Nevada, right? The number one college student in Nevada, aka my daughter, the number one IBC guy in Nevada, and Cameron. Right? Yeah, you totally saw that coming. And the cool thing is the winner was actually Sarah,
Mm-hmm.
my daughter, which is, I mean, everybody likes a game where they win, right? But it kind of showed, that was a good example of showing them about, like, what I like is you can land on a place called Doodads, which I landed on a couple, and I bought a big screen TV with money I didn't have, right? I redid my kitchen with money I didn't have, so I had to take a loan, which meant I had to pay interest, right? So you kind of learn some of those expenses, but also it's a great way to learn about passive income, because the goal of cash flow, if you haven't heard cash flow, it was founded by Robert Kiyosaki. I would say it's more of a real life monopoly. The whole goal is to get financial independence, Robert Kiyosaki defines that as your passive income being more than your expenses. So that is a great tool when kids are maybe a teenager. There's also a cash flow for kids, which you've probably played, but there's a lot of resources, and this doesn't really take a lot of money, right? And you're also spending some quality time, right, by playing a game or reading a book.
Absolutely. Couldn't agree more.
Now, if we go back to Nelson's book, one example he's talking about is kind of comparing the 40 years of forestry of creating a system for income and wealth, is you can do the same thing with your policies. And one thing he encourages or teaches is that the grandparents buy a policy on the grandkids.
Yeah, what I really enjoyed about that part of it was just a given, right? It wasn't a, hey, should I do this, should I not? It was one of those things where he's saying, hey, listen, this is what should be done, right? And I get excited about this. You kind of touched on it before, but man, I'm 10 years into kind of my IBC kind of venture, and I cannot even imagine what this is going to look like if we fast forward another 30 and I'm 40 years into it, and I've got policies on myself, my kids, and potentially my grandkids as well.
Right. And again, if we kind of make it a family, I don't know, call it a tradition or whatever it is, but the grandparents buy policies on the grandkids. If we do that, like what I will do for my kids, and I'm going to tell them, I expect you to get a policy on your grandkids. And so that's where we start building that generational wealth and more of the, I would say, generational legacy. Because again, so the policies will provide the dollars, but now it's up to the parents and grandparents to fill in the gaps with the financial education.
Yep. And the way that I look at it is, for whatever reason, right, my parents, grandparents weren't aware of this strategy, and now that I am, is somebody's got to kind of take a stand and step up and say, hey, listen, this is the strategy that I'm going to implement for my family moving forward.
Perfect.
Yeah.
And so then he ends it saying, building a banking system is a lot easier than building a forest.
Yeah.
You don't have all those expenses. You don't have property tax. One thing he didn't put in here, you also don't have income tax in here as well, because we're creating some tax-free legacy.
Yep.
And he also mentioned a number of advantages that he lists in doing this. And to me, a couple stood out. Was we have the generation paying the premium, aka the grandparents, and they're in a position that can probably afford it the most, right? And then when the death benefit occurs, because remember, It's not if, right? It's when. When the death benefit occurs, the system now becomes self-sustaining because now there's a windfall and we can continue to pass that along. And also we talked about the wealth mentality is transferred to succeeding generations over a long period of time to produce consistent understanding. They are a learning process. They are learning a process, not buying a product. Yeah, how many times do we talk about, right, process over product, right?
We talk about it so much, we're going to put it on a shirt. so we got to put that on a shirt, right? That's kind of our mantra. And this is just another example of that is, man, we're teaching lessons and providing the education to the next generation.
He ends this chapter, which, you know, I would tell, I mean, again, we've talked about how many more times I've read this than you, Cameron, but every time I read it, I always pick up something different, and this time was no exception. He ends this chapter with money won't buy happiness. Totally true. But poor stewardship of money will steal happiness. Also very true.
Very true.
All right. I hope you enjoyed this episode. Now go make it a fantastic day.
Take care.